Imagine if the stock markets fall 10%. Would you know how to protect your money? Hi, this is MK. I've been working in the financial markets for over 20 years, and today I'll show you a simple way how to protect your portfolio when the markets fall. But please keep in mind, this video is for education purpose only and it's not financial advice. The strategy uses SPY options, but before we start, let me explain in a simple way what SPY is. SPY is an ETF or exchange traded fund, which means it's a basket of many stocks. SPY follows the S&P 500, which is made up of the 500 biggest companies in the United States, like Apple, Microsoft, Google. So when the US stock market goes up or down, SPY also goes up or down with it. So that's why we use SPY, because it moves with the market, it's easy to trade, and its options are extremely liquid. Now let's look at how we use SPY options to protect a stock portfolio. So let's assume you have a US stock portfolio worth $100,000 and you're thinking that the market might fall 10%. So the potential loss to you could be $10,000. So the question is, can we buy insurance for this risk? And the answer is yes. And I'll show you an example using SPY options how this can be done. We will use something called a put spread. Don't worry, it sounds complex, but it's actually quite simple. A put spread means we buy one put and we sell another put at a lower price. This helps keep the cost low. So here is an easy rule. You buy the put which is 2% below today's SPY price, and you sell the put which is 10% below today's SPY price. And why do you do that? Because the first 2% is just daily noise. You really want protection for your portfolio if the markets fall more than 2%. And when we sell a put which is 10% below today's SPY price, it helps us in reducing the cost of our insurance. Let me show you by putting some numbers in. At the time of making this video, SPY is trading at 681. So 2% below 681 is 667. Because SPY options trade in 5-point ranges, the closest strike we can get to 667 is 665. So for our buy leg, we will choose the 665 option. Similarly, 10% below 681 is 612, and the closest strike available to 612 is 610. So for our sell leg, we will choose the 610 option. So our trade looks like this. We are going to buy the SPY 665 puts and sell the SPY 610 puts. And the time to expiry we are going to choose will be 90 days. So the 665 puts are trading at $12.21 and the 610 puts are trading at $4.58. Because we're buying one and selling one, we will pay $12.21 and we will receive $4.58. So the net cost to us is $7.63. Because each option controls 100 shares of SPY, our total cost is $7.63 multiplied by 100, which is $763. So now let's calculate what's the maximum payout that's going to be if we buy this insurance. The maximum payout is the difference in the strike prices multiplied by 100. So in our case, 665 minus 610, which is 55, multiplied by 100, which equals $5,500. In our example, we want to protect a loss of $10,000. So now, because one option is protecting a loss of $5,500, we will have to buy two options. That is simply 10,000 divided by 5,500 gives us approximately 2. So our total cost in buying this insurance is $763 times 2 equals $1,526. That is just 1.5% of the value of our portfolio, which is great. Because as a rule of thumb, your insurance should not cost you more than 2% of the value of your portfolio. Now let's see what happens if the market falls 10%. When the market falls 10%, your portfolio value will drop by $10,000. 100,000 times 10% is $10,000. Now let's look at the insurance payout. Each put spread had a maximum payout of $5,500. Because we took 2 put spreads, the maximum payout we're going to get is 5,500 times 2 is $11,000. So as you can see, if the markets dropped 10%, our portfolio loss was $10,000 and our insurance payoff was $11,000. So our insurance covered the whole loss of our portfolio. Here are 4 simple rules on when to buy insurance. Number 1, only buy insurance when the fear in the market is low, which means the VIX is low. Consider to put on insurance when VIX is in the low teens. Number 2, avoid very short expiries. The optimum number of days to expiry is usually 90. Number 3, do not hedge all the time. As hedging carries a cost, the cost will hamper the returns of your portfolio. Number 4, keep the cost of insurance to the maximum of 2% of the value of your portfolio. Well, that's it from me today. Thanks for watching. If you found this useful, please like, share, and subscribe to my channel. This is MK signing off. I'll see you in the next video. Bye. Past returns do not guarantee future performance. Always do your own research and speak to a licensed professional before making investment decisions.